This is no longer a contained regional strike. Energy markets are preparing for disruption, and American households could begin feeling the financial impact within days, not months. Over the past 24 hours, military escalation in the Persian Gulf has directly targeted the maritime corridor responsible for nearly 20% of global oil flows. When that artery is threatened, inflation, bond markets, equity valuations, and household purchasing power react immediately. The core question is not whether this is a geopolitical flashpoint. The structural question is whether the global energy system, and the debt-heavy economic architecture built upon it, can absorb another sustained supply shock. This is the ETN War Intelligence Brief. We are setting aside rhetoric and focusing exclusively on economic transmission, oil flows, inflation risk, market repricing, and household exposure. Over the weekend, US and Israeli forces initiated coordinated strikes targeting Iranian nuclear and military infrastructure, including facilities in Fordo, Isfahan, and Natanz. Iranian leadership infrastructure and missile installations were reportedly targeted. In response, Iran launched ballistic missile and drone retaliation across Israeli territory and against US military assets in the Gulf region. Most significantly for the global economy, Iranian state media announced restrictions on maritime movement through the Strait of Hormuz. The strait processes approximately 20 million barrels of oil per day, roughly 20% of global consumption, alongside a comparable share of global LNG flows. Alternative pipeline bypass capacity from Saudi Arabia and the United Arab Emirates totals approximately 6 to 7 million barrels per day. Under simple supply arithmetic, that leaves a potential deficit of roughly 13 million barrels per day if full closure conditions persist. For context, the 1973 oil embargo removed approximately 4.4 million barrels per day and triggered a 300% increase in oil prices. Because these developments occurred over the weekend, formal exchanges were closed. However, in thin liquidity conditions, alternative trading venues and physical markets reacted sharply. In illiquid off-hours conditions, gold-linked instruments traded significantly above Friday settlement levels. In parts of Asia, physical silver premiums widened aggressively, with some dealers reportedly quoting triple-digit buyback levels relative to Western benchmarks. These are not stable benchmark settlements. They reflect liquidity stress and pre-positioning ahead of formal market reopening. When exchanges reopen, energy futures are expected to gap higher, and volatility indices may spike into crisis thresholds. If the VIX moves above 35 to 40, levels historically associated with forced deleveraging, automated institutional risk-off positioning could accelerate non-linearly. Under ETN's duration-based supply shock framework, using 1973, 1990, and 2008 elasticity comparisons, a sustained 13 million barrel daily supply deficit would place crude in the $140 range within days. If disruption extends toward 30 days, our stress modeling suggests crude could mechanically move into the $180 to $200 per barrel range. This is not a prediction. It is a scenario output under sustained closure assumptions, limited alternative routing, and constrained strategic petroleum reserve intervention. Temporary shocks create volatility. Sustained shocks change economic regimes. Using historical pass-through ratios, every $10 increase in crude translates to approximately 20 to 25 cents at the pump. If crude stabilizes near $150 under a prolonged disruption scenario, national average gasoline would mechanically adjust toward $5.50 to $6.25 per gallon. In high-tax states, that range could exceed $6.50. For the median U.S. household, that represents an additional $1,200 to $1,800 in annual fuel costs. That functions as a regressive tax. Discretionary spending declines immediately. Diesel pricing moves nearly one-for-one with crude in shock conditions. A doubling of diesel prices directly increases trucking and logistics costs. Retail and grocery margins are thin. Transportation cost increases pass through rapidly. Under elevated diesel scenarios, essential goods inflation could accelerate meaningfully within weeks, particularly in food and consumer staples categories. An oil-driven inflation resurgence traps the Federal Reserve. If inflation reaccelerates while growth slows, the Federal Reserve cannot cut rates aggressively without risking inflation entrenchment. Mortgage rates would remain elevated. Credit card rates remain high. Auto loans remain restrictive. Housing transaction volume freezes. This is textbook stagflation pressure. Global equity market capitalization exceeds $100 trillion. In a moderate correction scenario of 10%, That implies roughly $10 trillion in paper wealth contraction. In a severe escalation scenario, historical crisis drawdowns of 30 to 40% would imply potential paper losses exceeding $30 trillion. Again, this is stress modeling, not prediction. Defense contractors stand to see immediate capital inflows. Missile interceptors, air defense systems, and precision munitions inventories deplete rapidly in high-intensity environments. Energy producers, particularly U.S. shale operators, experience revenue windfalls under elevated crude pricing. Conversely, airlines face severe margin compression. Jet fuel costs could rise 40 to 60% under $150 crude modeling. Shipping insurance premiums for Middle East transit routes are repricing higher. Petrochemical and industrial manufacturers reliant on cheap energy inputs face margin compression. Capital rotation will be swift. China imports significant volumes of Gulf energy. Over 80% of Hormuz flows are destined for Asian markets. Under prolonged closure conditions, Chinese industrial output faces severe energy cost inflation. Beijing's strategic petroleum reserves provide temporary buffer capacity, but sustained disruption would pressure domestic growth. India relies on the Strait of Hormuz for approximately 70% of its oil imports. Under $150 crude modeling, India faces direct inflation acceleration and currency pressure. Emerging markets with high energy import dependency face twin risks: currency depreciation and food inflation. We model three structural pathways. The first is contained conflict with diplomatic stabilization. Oil spikes temporarily before retracing. Markets correct but recover. The second, and currently more probable under continued hostilities, is prolonged disruption without full blockade. Oil stabilizes between $120 and $150. Global growth slows materially. Recession probability rises. The third is low probability but high impact: sustained maritime blockade of Hormuz. Under that stress case, crude approaches $200, global equities face 30 to 40% correction, and central banks confront synchronized stagflation. Duration determines regime shift. Even if immediate hostilities subside, the repricing of geopolitical risk is permanent. Defense spending trajectories will rise structurally. Energy transit diversification will accelerate. Supply chains will reroute, accepting higher costs to reduce geopolitical exposure. That embeds a higher inflation floor into the global system for years. The US dollar may initially strengthen as a safe haven, but prolonged weaponization of energy flows accelerates multipolar settlement experimentation. The greater danger is not the first price spike, it is duration. Temporary shocks create volatility. Sustained shocks permanently reprice economic systems. In periods of volatility, disciplined analysis matters more than reaction. We will continue modeling oil flows, bond yields, currency positioning, and inflation transmission as this situation develops. If you value structured macroeconomic intelligence over emotional narrative, subscribe to ETN. In unstable environments, clarity becomes a strategic asset.